Nobody who claims Bitcoin is heading to zero actually believes that. Not the internet troll dropping skull emojis in your comments. Not the Nobel laureates who've been penning its eulogy since it traded for 11 cents. Not even Peter Schiff, who has publicly pronounced Bitcoin dead 22 separate times and still, somehow, won't utter that specific word. My name is Yank. Right now, there's a woman named Marin sitting in a Sacramento parking lot before her shift starts, 43% underwater, who's stopped telling her sister the actual number. There's a man named Colton in western Kentucky running 8 mining rigs out of a converted horse trailer, crunching numbers against his power bill. Neither of them is getting a straight answer today, because zero is the easy question to ask. Zero has a tidy answer. And the bulls, the bears, and everyone selling something in between would much rather you kept asking it. So let's figure out where things actually stand, because the emotional temperature of this conversation has way outpaced the data. Bitcoin topped out around $126,000 in October 2025. As I record this, it's sitting in the mid-$60,000s. Call it a 48% drawdown, half your money gone in 9 months. Here's the first thing nobody mentions: that's not the interesting part. The interesting part is how it got there. Bitcoin didn't crash. Bitcoin has crashed before, and everyone knows what that looks like. In 2011 it fell 93%. In 2021 and 2022 it dropped from $67,600 down to $15,700, a 77% haircut, and a brutal one at that. Every prior Bitcoin bear market wiped out somewhere between 77% and 93% from the peak. Look at the shape of this one, because it's different. Those were crashes, violent, fast, and over. This time the price walked down a staircase, step, pause, for 9 straight months. That matters, because a crash triggers panic, and panic produces a bottom. A staircase produces something else entirely: exhaustion. It produces that particular 2 a.m. feeling where you stop being scared and start being embarrassed. Fidelity, which sells crypto products and therefore has every incentive to sound upbeat, put it bluntly earlier this year: every previous bear market erased at least 77%. This one, at its June low, had erased about 53%, which bulls read as proof the market has matured, and bears read as proof it isn't finished yet. Both are guesses. Neither answers Marin's question. Before we get to that answer, one note, because plenty of you watching hold exactly 0 Bitcoin and are quietly wondering why any of this is your problem. It's your problem because you're going to be forced to have an opinion whether you want one or not. Your brother-in-law has one. Your retirement plan is quietly adding a crypto option. Your feed has already decided you need one. And I want you to keep a guy named Grant in mind for the next 15 minutes. Back in 2014, Grant put $500 into Bitcoin because a coworker wouldn't shut up about it at lunch, not because he understood it, but because the alternative was being the only one at the table without any. That's the single most common Bitcoin origin story in America, and it has nothing to do with monetary theory. More importantly, the underlying skill here transfers. How do you value something that generates no cash flow? That's not a crypto-only question, it's the gold question, the raw land question, the collectibles question, and the question sitting behind every private company anyone's ever pitched you at a cookout. Get it right and you own a tool. Get it wrong and you own an expensive hobby. So let's actually answer it, not the vibes version, the mechanical one. What would it physically take for Bitcoin to hit zero? There are 4 pathways, and I want to walk through all 4, including the one that hands the bulls a clean win, because a bear case that won't concede anything isn't analysis, it's a personality trait. Pathway 1 is the one everyone pictures: the network breaks. Someone attacks it. Miners abandon ship. The whole system collapses under its own weight. Not close. As of the middle of this year, the network is running at or near record computing power. Buying enough hardware to take it over would cost north of $10 billion, and running the attack would burn over $1.5 million an hour in electricity alone. Here's the genuinely odd part, and it's worth sitting with: computing power kept climbing while the price fell. Miners added capacity into a falling market. The network is fine. The network is aggressively fine, arguably healthier than most of the people who own it. So cross pathway one off the list. If you came here expecting a story about Bitcoin technologically collapsing, this isn't that video, and I'd gently suggest anyone selling you that story hasn't looked at a hash rate chart in 4 years. Which brings us to pathway 2, and this is where it stops being comfortable, because something did break this year, just not the code. For 15 years, Bitcoin's price came down to whether a very large number of individual humans wanted to buy or sell. Emotional, chaotic, unpredictable, but human. Then the exchange-traded funds showed up. The corporate treasury companies showed up. And the industry sold everyone on one specific promise: institutional money means stability, adults in the room, no more panic selling. Here's what actually happened. Research cited across this year's flow coverage estimates that ETF flows now explain roughly 45% of Bitcoin's weekly price movement. 45%, not sentiment, not adoption. Plumbing. And plumbing doesn't have conviction, plumbing has a redemption schedule. In June, those funds posted the worst month in their history, somewhere between $4 billion and $4.5 billion pulled out, depending which data provider you check, and I flagged that $400 million gap because 2 reputable sources disagree and nobody seems bothered by it. BlackRock's fund alone accounted for roughly 79% of the outflow. 2026 became the first calendar year since launch where net flows went negative overall. Hold that thought, because it gets better or worse depending entirely on your position size. Back to Colton in the horse trailer. Colton doesn't have opinions about monetary policy. Colton has a power bill. In the first quarter of this year, publicly traded miners, the kind Colton competes against, sold more than 32,000 Bitcoin. A single quarter record. That beat everything they sold in all of 2025 combined, and it beat what they dumped during the Terra collapse back in 2022. Mining revenue per unit of computing power fell into the high $20 range against a break-even point near $35 for older machines. One large operator liquidated its entire treasury. Another took its holdings to zero. Colton didn't sell because he lost faith. Colton sold because January was cold and the bill was due. Then there's the third seller, and this one rewrote the whole story. Strategy, the company formerly known as MicroStrategy, built its entire corporate identity around 4 words: we do not sell. On June 29, they authorized selling up to $1.25 billion of Bitcoin, roughly 20,000 coins, to cover cash reserves and preferred dividends. The stock is down about 80% from its high. They still hold around 844,000 coins, roughly 4% of every Bitcoin that will ever exist. The reason comes down to a metric called MNAV, which sounds like a boy band and basically means the market has decided your company is worth less than the pile of assets sitting inside it. Here's the loop, laid out plainly: price falls, so the premium that funded the buying disappears. No premium, no stock issuance. So you sell coins to cover the dividends. Selling coins pushes the price down further, which makes the premium worse. That's not a conspiracy, that's a spreadsheet. So line up all 3, the funds, the miners, the treasury companies, Bitcoin's 3 largest structural holders, all became net sellers within the same 6 months. And not one of them did it because they changed their mind about Bitcoin. Redemption mechanics, electricity costs, preferred stock dividends, institutional adoption didn't remove the panic seller from this market. It replaced him with something that sells on a schedule and doesn't read the comments. Okay, deep breath, the other side gets the floor now, because if I only made the bear case, I'd be doing exactly what I just accused everyone else of doing. Somebody built a website whose entire purpose is tallying how many times public figures have declared Bitcoin dead. It isn't satire, it's actively maintained, sourced, timestamped, and searchable. As of this month, it lists 475 Bitcoin obituaries. The first ran in October 2010, when Bitcoin was worth 11 cents. Peter Schiff alone is responsible for 22 of them. Someone crunched the numbers, and it's genuinely delightful. If you'd put $100 into Bitcoin every single time someone declared it dead, you'd have invested $47,100 total and would now hold roughly $1,043 worth of Bitcoin at today's price, about $67 million. That makes it possibly the single most effective investment strategy ever devised, and it consists entirely of ignoring economists. The bull case isn't purely historical, either. Long-term holder supply hit a record this year, about 14.8 million coins sitting in wallets that haven't moved in over 5 months. Somewhere between 2.3 and 5 million coins are gone for good. And Fidelity's research team found that roughly 566 coins a day are aging into the category analysts call ancient, untouched for a decade, while daily new issuance is only about 450. Read that again, coins are disappearing faster than new ones are being created. Great, case closed, buy the dip, see you at $100,000. Except here's the problem with those 475 obituaries, and I say this as someone who genuinely enjoys them, that's not evidence, that's a base rate. A base rate tells you what usually happens, and, it usually comes back, is the exact reasoning that has talked people into averaging down on every asset that never did come back. Every stock that eventually hit zero had years where the people calling it doomed were wrong. Being wrong for a long stretch is what being early looks like from the outside. It's also what being flat out wrong looks like from the outside, and you cannot tell the two apart in real time. That's not a flaw in your analysis, that's just the situation you're in. Which brings us back to that parking lot. On June 25, the amount of Bitcoin held below its purchase price hit 10.83 million coins, an all-time record. More than half of every coin in circulation was underwater at the same moment. Among recent buyers it's worse still, over 95% of short-term holders are sitting at a loss. Marin is in that group. She bought during the cluster between $107,000 and $118,000, the densest accumulation zone of the entire run. At the midpoint, she's down 43%, and she needs a 76% gain just to get back to even, not to profit, just to be where she started. Nobody knows exactly how many Marins there are out there, because the industry can't even agree on how many Americans own this stuff. The Federal Reserve surveyed nearly 13,000 adults and found 10%. A Motley Fool survey of 2,000 people found 22%. A third estimate put it at 30%, or 70 million people. That's a threefold spread on the most basic question in the entire sector, and I'd trust the Fed's number, since 13,000 randomly selected adults beats 2,000 volunteers every time. What we do know is position size, and it isn't what the internet implies. The most common crypto holding in America falls between $100 and $1,000. The second most common falls between $1,000 and $5,000. The average gets dragged upward by a small number of enormous wallets. The typical holding is a few $1,000s that somebody couldn't really afford to lose, and put in anyway, because the alternative was watching everyone else get rich. That's the actual demographic here, not whales, not institutions, but people holding an amount too small to change their life and too large to shrug off. Now, back to that open loop from the start, let me close it, because it's the actual thesis of this video. Peter Schiff, back in June with Bitcoin sitting around $65,000, said this: for all practical purposes, for most investors, it will feel like zero. Bitcoin will lose over 99% of its market value, even if it technically still trades above zero. The most committed Bitcoin bear alive was handed a clean opportunity to predict zero, and declined. He predicted 99%, and he predicted survival. Even the bears aren't arguing for zero. They're arguing for something functionally worse and rhetorically weaker, an asset that lives forever and never pays you back. That's the reframe I've been building toward this whole time. Zero was never the real risk. The risk is something that survives indefinitely, gets covered respectfully in the press, keeps its network running, and simply never returns your capital within your investing lifetime. There's a real structural argument underneath all of this, and it's the one nobody puts on a thumbnail, because it needs 90 seconds and a picture. So here's the picture. Colton is a bouncer. He gets paid two ways, a guaranteed salary from the club, and tips from the people walking through the door. Right now the tips amount to about 0.6% of what he takes home. The salary is everything. And every 4 years, the club cuts his salary in half, not because he did anything wrong, it's written into the contract, it's public, and everyone's known since day one. Meanwhile the club keeps getting bigger, and the people trying to get in keep getting richer. Run that forward, by 2036, his salary is down to roughly an eighth of what it is today. So one of three things has to be true: the value of what he's paid in rises roughly eightfold, or the tips grow by a factor of well over 100 and start doing the job the salary used to do, or the guy guarding more than $1 trillion ends up working for a fraction of what he makes now. Nobody has a satisfying answer to that, not the bulls, not the bears. It's the only argument in this entire video that doesn't hinge on anybody's mood, and it won't resolve for another decade, which is exactly why it never makes a thumbnail. There's one more, and it got dramatically more real this year. In February, a proposal called BIP 360 was merged into Bitcoin's official code, introducing the first quantum-resistant address type. 2 months later, a companion proposal laid out something far more dramatic: a plan to migrate, and potentially permanently freeze, somewhere between 6.7 and 7 million coins sitting in addresses that a future quantum computer could crack. That's roughly a third of all supply, including an estimated 1.7 million coins widely believed to belong to Satoshi Nakamoto himself. The proposal's own text states that, as of March 1st, more than 34% of all Bitcoin has revealed a public key on the blockchain. Google researchers this year cut the estimated resources needed to break those signatures by roughly 20-fold. Serious people disagree wildly on the timeline, some say 5 to 7 years, while Adam Back, who's been building this stuff since the 90s, says 20 to 40. But sit with the shape of the problem for a second: in order to protect the money that supposedly can't be confiscated, they may have to confiscate a third of it. That might be the most Bitcoin problem that has ever existed, and there's no version of solving it that doesn't cost something real. So, is Bitcoin going to zero? Almost certainly not, and I want to be completely direct about that. The network works. Computing power is at record highs. The lost coins are real. The 475 obituaries are funny, and they're instructive. But that question is a trap, and both sides benefit from it, which is exactly why you're never offered anything else. The bulls love the zero question because it's easy to win. The bears love it because it makes them sound brave. And while everyone argues over the extreme, nobody makes you answer the three questions that actually decide what happens to your money. 1. Who's the buyer after you, and what do they have to believe? 2. What specifically and numerically has to be true for this to work out over your holding period, not the internet's? 3. What does not going to zero actually get you if it takes 15 years just to break even? Marin went looking for an answer to the zero question and didn't find one worth having. What she found instead was that she'd never once written down what it would take for her $4,200 to become $8,000. Not hoped for, written down. And when she finally did, the honest version required the price to roughly double within 6 years. Entirely possible, and also something she couldn't have defended for 60 seconds against anyone pushing back. So she didn't sell, and she didn't buy more. She wrote the number down and gave herself a date to check it. It isn't a triumphant ending, it's just the first time in 9 months that she was making a decision instead of absorbing one. Colton is still out in the trailer. His math gets measurably harder every 4 years, regardless of anyone's opinion, something he understood long before most people writing about this ever did. And Grant, from earlier, the $500, the coworker at lunch, he forgot the password. He's part of the millions of lost coins propping up the entire scarcity argument. He's been contributing to the bull case for 12 years completely by accident, and he's personally received nothing for it. I think about him a lot, because that's a suspiciously accurate description of how a lot of people experience this asset. I'm not a financial advisor, and this isn't financial advice, it's arithmetic and a long look at some very public documents. Here's what I'd leave you with: you're allowed to look at all of this, decide you can't honestly answer those 3 questions, and simply not take a position. Sitting out is a position. It has a return. It has a risk profile. And it doesn't require you to be right about quantum computing. And if you can answer all 3 questions out loud, without flinching, to someone who actively disagrees with you, then you don't need a video to tell you what to do. That's the whole test. Everything else is just somebody's story about why the next buyer is going to show up.